Hi everybody, just a quick economic update. There's probably 5 to 6 sort of things that I'm having a pretty close look at the moment. The top of the list is what we're seeing around the globe at the moment. Obviously we're seeing uh, more containment, particularly across the Western world, which is encouraging in regard to COVID. It's definitely been a case of what we call sort of risk on. Equities have been surging up sharply. The New Zealand dollar too, Australian dollar has been rising. A lot of it looks to be driven by liquidity as opposed to the economic fundamentals, because the economic data out there still looks pretty tepid. We're also seeing the developing world's improving, but of course the underdeveloped world, if you look at Brazil, these sort of countries have still got major problems coming through there. Really interesting to see what's going on in the United States at the moment and around the globe in regard to civil unrest. Looks to be a bit of a lightning rod on fixing lots of economic issues, income disparity, housing. The words of Twisted Sister, we're not going to take it anymore, are starting to ring louder and louder in my ears. Are the marches about racism or symptomatic of the gap between the haves and the have-nots? I think a fair bit of this is just that gap between the haves and the have-nots is coming to the fore. So watch this space. Locally, seeing a pretty clear improvement across a range of economic indicators. Pay mark spending data is up, around levels we're seeing 12 months ago. Some of that I think will be a bit of pent up demand. We've been locked up for a while. So what's happened? People sort of rushed out and stocked up on your winter stock and these sort of things. Our traffic volumes are up, although still down on where we were 12 months ago, but we're heading in the right direction. Our job seeker benefit number growth has slowed, although I suspect that's only temporary. Watch out when we see the wage subsidy coming to an end. The essential scenario to me still looks like it's a U-shaped recovery. Major issue out there is that whether we see sufficient rebound in the level of activity to stem the cash bleed. We're getting close to the levels of activity we were experiencing pre-COVID, but we're still not at that sort of magic, line that sort of signals there's going to be a return to normal. In all honesty, I don't think that return to normal is going to be around the track anytime soon. Just in regard to government stimulus, I was looking through the Crown accounts the other day. Obviously, we're expecting a pretty big government injection. We've got that. If you look at the budget numbers, they're expecting net capital spend to average about $9 billion per year from 2019 to 2024. To put that in perspective, net capital spend under the previous government was a bit under $4 billion per year. Big issue going forward, though, if I look at the government projections beyond 2024, they've got net capital spend going from about $9 billion down to $3 billion. Now that's going from a feast to a famine. And one of the real issues we've got across New Zealand at the moment is that sectors such as construction sector, they need certainty, stability in regard to what that profile is going to be like for capital spend. What we've got at the moment is obviously an injection that's pretty big. There's more money to go because the COVID relief package is still yet to get allocated in regard to infrastructure. But a real problem on the other side is as we load up the government balance sheet, they're basically committing to a bit of a spending or investment diet on the other side. Once again, boom to bust. What I'm also seeing is more stories on local government cutting back spending capital investments. The most vulnerable councils are the ones that have got higher debt and are in high growth areas. So these are councils such as Auckland, Hamilton, Tauranga, Western Bay, Plenty, Christchurch to a degree as well. But generally speaking, all those councils have got a lot more pressure on their balance sheets. So they've got high debt and they're expected to suffer some pretty big income losses. Now, my personal view is that if I was a council, I'd still be spending, I'd still be borrowing to support the economy, because your interest cost is going to be hellishly low over the coming few years. But what we're starting to see is the opposite result, where councils are actually dialing back some of the investment projects. So government stimulus is going to be partly offset, it looks like, by some restraint on the local government side. Just the RBNZ are seeing mortgage rates continuing to fall. That's more stimulus into the system. We've now got fixed mortgage rates down below 3%, and that's providing real big cash relief into the household sector, although the obvious issue for the household sector is whether you've got a job. But monetary policy is working, and banks are seeing more money coming in the door in the form of deposits, savings, transactional accounts. The money's going out the door on the other side. So at the moment they're pretty flush with cash. What does that mean? Well, you shift the relative price in one direction. What does that mean? You cut deposit rates, you cut borrowing rates on the other side. A big thing I'm focused on at the moment as well is the consumer. What is the other side going to look like? Obviously we're seeing a rebound at the moment as we get back into that sort of that normal, or try to assess what is normal. But across the Western world, your consumer is about 60 to 70% of the economy. And million-dollar question is that the consumer going to change their behaviour on the other side? Are they going to save more, or are they going to spend the same? Now, my inclination is that they're probably going to save more and spend less. And so welcome to the new normal. We're going to be watching a pretty close eye on building consent as a bit of a barometer in regard to that spending versus saving sort of dynamic. Obviously, consent numbers for March and April were down, but the asset test for the construction sector is really going to be what we see in regard to building consent numbers over the months of May to September, because that's going to define the pipeline for 2021. Paying pretty close attention to the commercial market at the moment. It's very pro-cyclical. Tends to take 2 years to trough. There's a big stock of accommodation and retail that is hitting the market. Good news for the commercial property market is that if I have a look at risk premiums, or the gap between commercial property yields and some artificial interest rates such as 5-year, 10-year swap rates, they've actually been pretty stable. Yields have come down, but that reflects lower interest rates. If you look at the risk premium to the sector, the risk premium, the gap above interest rates has still been up around 5 to 6%. Now, what does that say? We haven't seen the same degree of exuberance within the commercial property market that we saw in 2008 that required a little bit of a flushing on the other side. Way back in 2008, risk premiums in the sector, with a gap between the yield and the interest rate, got down to zero. Now that necessitated a pretty big clean out in regard to asset valuations correcting on the other side. But the sector nowadays, it's still got $40 billion worth of debt. A lot of stock is hitting the market. I expect to see more continued shelving of projects for a while, but it tends to take a little bit longer to flow into the commercial property market. Look, I know that infrastructure stuff out of government is going to provide a bit of an offset, but the mainstay of the construction sector in New Zealand is that commercial, non-residential and residential work, and expecting that to be well down over 2021. Finally, just a stat of the fortnight, something to sort of think about out there. I was looking at some education statistics the other day, and I found a horrifying one. Only 57% of kids are defined as regularly attending school. Now, to be defined as regularly attending school, that means you've got to be at school 90% of the time. Now, 3 years ago, that's that 67% of kids were what was called regularly attending school. So in the space of 3 years, we've dropped 3 percentage points. Now, I look at those sort of things and I scratch my head about what could be going on across the education sector, because that defines tomorrow's workforce, workers, and if we don't sort out that sort of stat, boy, are we going to have some major social problems on the other side.